2.25% might become the most important number in Canadian personal finance for the next 2 years. Here's exactly what the Bank of Canada's expected December 10th hold means for your wallet. After a series of rate cuts earlier in 2025, economists are calling this the end of the easing cycle. But what they're not explaining is how this creates a rare period of rate stability that investors and homeowners can use to their advantage. I'm going to break down how this impacts your financial planning, starting with the economic data that most people completely missed. Hi, Kane again. I've been in the housing industry for nearly 20 years. Be sure to watch my biography video to learn about my story. Also, don't forget to check the description below for the references to see where I pulled this information from. If there are any errors, please let me know. This video is created for entertainment purposes only and should not be used to make any financial decisions. Please do your own due diligence. Without further ado, let's break it down. The third quarter GDP numbers came out last month and most people ignored them. They shouldn't have. Canada's economy grew at 2.6% annualized in Q3, and that single number just rewrote the Bank of Canada's playbook for 2026. Back in early 2025, the story was completely different. Growth was weak. The Bank of Canada had cut rates through several decisions, bringing them down from higher levels to the current 2.25%. The plan seemed clear: provide monetary support until the economy picked up steam. Most economists were calling for even more cuts to support struggling growth numbers. The bank felt confident about this approach because the data supported it. Weak GDP readings, rising unemployment, and concerns about a deeper slowdown. The rate cuts were meant to provide the monetary support Canada needed to avoid a harder landing. But the Q3 GDP report flipped that script. At 2.6% annualized growth, this was way above what anyone predicted just a few months earlier. The Bank of Canada had to completely rethink their strategy. You don't keep cutting rates when the economy is already growing at a healthy pace. Here's what makes this number so important for your finances. When growth is strong, the economy doesn't need cheap money to function. The Bank of Canada realized they had already provided enough stimulus through their previous cuts. More cuts would risk overheating an economy that was already performing better than expected. The inflation picture makes this even more clear. Headline inflation is sitting right near the 2% target. Core measures are slightly above 2%, but nothing that screams emergency. When you combine solid growth with controlled inflation, you get the perfect setup for stable rates. This is why economists now treat 2.25% as the floor, not just another step down. The bank has signaled they're moving from active cutting to what Governor Tiff Macklem calls a more cautious approach due to unusual uncertainty. In plain terms, they need to be less forward-looking than normal until trade tensions and U.S. tariff uncertainty become clearer. The shift happened fast. Market probabilities now show a low chance of another December cut, reflecting how dramatically the situation has changed. Bond markets have already priced in a hold. Major bank forecasts all point to a pause at 2.25%. They don't want to cut too aggressively and then have to reverse course quickly if inflation flares up again. The Q3 growth numbers gave them the perfect excuse to pause and assess, especially with ongoing trade policy uncertainty, adding complexity to their decision-making. Your mortgage renewals, investment decisions, and borrowing plans can now be made with a 2-year horizon instead of hoping rates keep falling. But the bank's shift in messaging tells an even deeper story about what comes next. The Bank of Canada's language started changing after those rate cuts. Most people missed it, but the shift from active easing to data-dependent tells you everything about what comes next. They stopped promising more cuts and started talking about watching the numbers. Data-dependent means they wait for economic reports before deciding. No more preset plans to keep cutting rates. Each meeting depends on what the latest GDP, inflation, and employment numbers show. This approach puts your financial planning in a holding pattern because you can't predict their next move based on past patterns. The problem they face is tricky. Headline inflation looks good at around 2%. Core inflation measures tell a different story. These core numbers strip out volatile items like gas and food prices. They focus on the underlying inflation trends. Core measures still sit slightly above 2%, which keeps the Bank of Canada on edge about cutting more. Energy prices dropped this year and pulled headline inflation down. But core measures show the pressure is still there beneath the surface. The bank knows that headline numbers can change fast when energy prices move. Core inflation gives them a better read on what's really happening in the economy. This creates a balancing act. Cut rates too much and you risk inflation flaring up again. Hold rates too high and you might slow growth too much. The Bank of Canada learned this lesson the hard way in previous cycles. They cut aggressively, then had to reverse course when inflation came back stronger than expected. Market probabilities show how fast this thinking changed. 2 months ago, markets gave higher odds of another December cut, reflecting how dramatically the market has shifted. Bond traders and mortgage analysts now expect the bank to hold at 2.25%. People are betting on stability, not more cuts. Budget 2025 assumptions support this cautious approach. The federal budget projects inflation averaging just near 2% through 2025. These government forecasts influence how the bank thinks about policy. If inflation stays near target, there's no pressure to cut rates further. External factors make the decision harder. Trade policy uncertainty from the US creates economic risks that could go either way. The unpredictability of trade negotiations makes them more likely to wait and see rather than cut preemptively. When economists say the easing cycle is largely complete, they mean the era of falling rates is over. You need to plan for stable rates around 2.25% through 2026 and possibly into 2027. The bank won't cut unless growth disappoints significantly or inflation drops well below target. This shift from cutting to holding changes how you approach borrowing and investing. Instead of waiting for lower rates, you plan around stable rates. But this stability creates something most Canadians haven't experienced in years. A stable 2.25% rate creates opportunities that haven't existed since before the pandemic. Most Canadians may still be thinking in terms of falling rates. They keep waiting for the next cut that probably won't come. If you have a mortgage renewal coming up, you can try to plan with confidence. You don't need to hope rates will keep dropping. Fixed mortgage rates have already priced in most of the rate stability we're seeing. Waiting longer won't save you much more money. The banks know where rates are headed, and they've adjusted their pricing accordingly. 5-year fixed rates sit around 3.89% to 4.19% right now. Those rates factor in the expectation that the Bank of Canada will hold at 2.25% for an extended period. If you keep waiting for better rates, you might miss the current offerings. Rate stability means you can lock in your renewal terms without worrying about timing the market perfectly. The housing market gets a different dynamic under stable rates. We're moving away from the boom-bust cycles we've seen over the past few years. Gradual stabilization replaces the wild swings in prices and activity. Buyers can plan purchases without wondering if rates will drop another point next quarter. Sellers can price properties without fear of rate spikes killing their deals. This stability benefits investors in ways we haven't seen since 2019. Mortgage investment corporations and real estate investors may finally get predictable funding costs. When you know your borrowing costs will stay around the same level for 2 years, you can calculate returns with confidence. The spreadsheets actually work again. The risk calculation shifts under stable rates. You stop worrying about interest rate volatility. Your focus moves to credit quality and economic growth sustainability instead. Can your tenants keep paying rent? Will your commercial borrowers stay in business? These become the important questions, not whether rates will move up or down. The bank has cut rates significantly from their peak of 5.0% to the current 2.25%. They moved faster than most central banks because inflation came down quicker in Canada. Now they sit below the midpoint of their estimated neutral range. This positioning suggests they have room to hold steady without hurting the economy. Canada's Q3 GDP growth at 2.6% annualized created the foundation for this rate stability. Strong economic performance lets you plan with a 2-year horizon instead of guessing quarter to quarter. Some forecasters suggest this stability could extend into 2027, which may give you an even stronger foundation for long-term. This stability window gives you a chance to make the financial moves you've been putting off. Lock in financing terms. Plan your investment strategy. Make housing decisions with actual certainty about borrowing costs. The December 10th decision confirms a new era where 2.25% becomes your planning anchor for the next 2 years. You can finally make financial decisions without guessing where rates will go next quarter. Your mortgage renewals, investment strategies, and major purchases all get predictable borrowing costs. If you enjoyed this content and are interested in learning more about investing, be sure to check out what the difference is between mixed and mutual fund trusts.